one question. Has the dramatic and I believe welcome increase in transparency, including your own initiatives and those called for in the Wall Street Reform Act of 2010, had any adverse or troubling consequences either for policy making at the Fed or for the financial institutions that you regulate and interact with?
So we think the increases in transparency, particularly around monetary policy that we've taken in the last few years, have been very helpful and responsive and have improved understanding of the Federal Reserve and the policy actions we're trying to take. We've provided a lot of detailed information about credit transactions we engaged in during the crisis. There have been, Congress, we think, struck a very important balance between the need for access to that information and providing a delay so that participants in the transaction don't experience stigma that often occurs when there's an immediate release of information, allowing therefore an explanation for why institutions have participated in the facilities. We're monitoring whether there'll be any effect. We of course won't know until we see how these facilities operate in the future. We will keep the Congress informed on the effectiveness. If there is any bad effect, we'll let you know.
So you will inform the Congress as to if there needs to be changes in this law or whatever. Okay, thank you for your response. And at this time, Mr. Chairman, I'd like to yield the balance of my time to the gentlewoman from New York.
I thank the gentleman for yielding, and I thank the chairman for holding this important hearing, and I welcome both of our witnesses. I think we all have to remember that we were really on the verge of collapse, this was we had the Great Recession instead of the Great Depression because of the monetary policy in many of the steps that we took. One of those steps that we've taken to stabilize our markets and move forward is the Dodd-Frank bill, and in that we required the GAO to conduct an audit of the Federal Reserve, and we also required the Fed to make information about the transactions through emergency lending facilities from December 2008 to March 2010 available to the public. In addition, Dodd-Frank required that the Fed disclose information about the entities that used the discount window, or under, I believe it was Section 13.3 lending facilities. But in addition to what we required in Dodd-Frank, the Federal Reserve is also already subject to robust congressional oversight. And I'd like to ask our two witnesses, can you give the committee some examples of the types of congressional oversight that you are already required to do, even before Dodd-Frank?
The two of the most important types of oversight are the chairman of the Federal Reserve, the chairman of the FOMC, provides testimony on the economy twice each year on the call of the House and the Senate. And that is an important check on our monetary policy and the state of the economy. Another important method is this hearing and hearings like this that we're going through. The staff and the governors and the chairman of the Federal Reserve, the presidents of the Reserve Bank have often been called to Congress to report on every aspect of our duties and how we implement various policies. And you use those as oversight to us, and we explain the positions that we've taken. So I think it's the interaction between the Congress and the Federal Reserve in testimonies in particular that have been an effective form of oversight.
Okay, my time is about to expire, but as you know, there's a GAO audit authority now. Was there anything that is excluded from the GAO audit authority?
So the GAO is authorized to audit a full range of the Federal Reserve's responsibilities. That includes all of the emergency transactions, the discount window, our supervisory authority, our consumer authority, all the various aspects of authority. An area that is that Congress has reserved to the Federal Reserve is the implementation of monetary policy, the actual policy-making decision process. The GAO does look at how we implement the policy in the form of making sure the transactions actually occur as appropriate, that they're accounted for properly on the balance sheet, that they're fully disclosed. But the decision-making process for monetary policy is the one thing outside the GAO's scope of authority.
Mr. Chairman, may I follow up with one brief question on what are the arguments for excluding it? Why was that excluded? What is the arguments for it? Mr. Alvarez?
So the importance of allowing the Federal Reserve and the FOMC to conduct monetary policy independently has been demonstrated throughout the world in both actions by other central banks and in a variety of studies of monetary policy. The point, I think, is that the Congress wanted to reserve to the FOMC the ability to have discussions that are full and free and frank, and to explore all the possible alternatives for monetary policy to reach the best monetary policy decision. Moreover, if GAO doesn't do audits in the sense of a technical audit like a financial auditor might do, but does performance reviews and policy reviews. So that would mean that the GAO would review the alternatives considered for monetary policy, how the decisions were made, whether the decisions were actually appropriate. That would cause second guessing of the FOMC, cast into doubt whether the FOMC was actually making the policy decision or whether the GAO was making policy decisions in monetary policy, and make it more difficult for the monetary policy to be done effectively by the Federal Reserve.
Thank you. Thank you, Chairman.
Thank you. I now yield 5 minutes to the Vice Chairman, Mr. Jones from North Carolina.
Mr. Chairman, thank you very much, and I appreciate you holding these hearings, as others have said. And you know, I'm going to take a little different approach. I represent the 3rd District of Eastern North Carolina. It's a great district to represent, home of Camp Lejeune Marine Base, Cherry Point Marine Air Station, the Outer Banks. And the frustration of the average business person down in my district is very deep and severe. And we have had numerous inquiries from the 3rd District, the citizens of the 3rd District, about the Federal Reserve and how decisions are made. And I know you cannot go into some of the backroom negotiations at the Reserve. I'm not even asking that. But how do you say to the small business owner that, you know, in this crisis situation, we seem to find ways to help foreign banks, foreign entities. And I'm looking here at the note that my staff prepared for me that Harley Davidson, McDonald's, GE, Verizon, Toyota. And yet, I've got people in my district saying that I go to the local banks and I can't get any loans and my credit has always been good. Why and how does the Federal Reserve seem to be able to find the way to help these entities that are gigantic, and through greed and manipulation, they cheated, and yet they get bailed out. They get the help when the average business person down in Eastern North Carolina, and probably across America, they can't even go to a bank they've been banking with for 15 or 20 years and get a loan. And yet, here we are at the Federal Reserve looking at those foreign banks who might need some help, or these corporations that might need some help. It really is. That's why this hearing is very important. The transparency, the trust, that's a big word to me, trust, is just not there with the average citizen when it comes to the Federal Reserve. And yet, if it had not been for the push by, I won't name all the entities that pushed to tell you to show the bottom line, to show what was in the closet of decisions, who was being helped, we never would have known it. And yet, I know you gentlemen are attorneys, and you're probably not at the position where the person ought to be here that ought to be hand on a Bible to tell the truth to the American people. That's my concern is, how do we build the confidence of the American people when we see what is happening at the Federal Reserve?
So Congressman, we understand that and feel the same frustration. The programs that were designed and implemented by the Federal Reserve during the financial crisis were not designed to aid big companies for the sake of aiding big companies. The programs that we designed, for example, the TALF program that we designed, was designed to pass money and credit and liquidity onto the American people. So, for example, the TALF resulted in 3 million more auto loans during the crisis than would have occurred, 1 million more student loans, almost 1 million small business loans. The programs you're talking about that aided Harley-Davidson and Toyota and other companies were the commercial paper facility, which provided short-term funding to those companies so they could continue to keep employment up and manufacturing up in the United States, so that they could continue to provide jobs and provide opportunities in the United States. It was, our efforts were all designed to try to keep the economy moving in order to help individuals and small businesses, not for the sake of helping the larger institutions. And I understand that there's a different perception. Part of that perception, I think, comes from the fact that most of the financial tools that we're given are designed to work through banks or work through large markets. And it's working through, so we use the tools the best we can in order to have the funding aid the broadest range of people possible.
Well, I guess, Mr. Chairman, I know my time's about up, but I guess in a way that if it had not been for these Bloomberg and Wall Street Journal and all these raising the questions, doing the investigation, I don't know if we'd be having this hearing today. I don't know.
I thank the gentleman. I yield 5 minutes to Ms. Maloney from New York.
I thank the chairman for yielding, and as he is well aware, on Friday the jobs numbers come out, and the economy has been improving, not as fast as we would all like, but we are digging our way out of that hole. And now that we have the benefit of hindsight, and we are slowly recovering from the financial crisis of 2008, I know that some have taken the position, a position that I do not agree with, but they've taken the position that the Fed's lending during this time actually helped contribute to the crisis. And some have argued that the Fed didn't need to take the actions that it took because the situation would have stabilized on its own. But I'd like to ask our panelists today, isn't it true that without the actions that the Fed took, that by not setting up the facilities it did, by not giving institutions access to the discount window to provide additional liquidity to our economy, that the crisis would have been far worse? So your comments, please, Mr. Alvarez and Mr. Baxter.
Thank you, Congressman. We do believe that the facilities that we established, that the Federal Reserve established, did ease the crisis, and they certainly were designed to do that. The studies that are beginning to come forward now are starting to show that they actually were successful in unfreezing various markets, the commercial paper market, the asset-backed securities market, providing liquidity to the financial system that was important for the financial system to continue to operate. The funding that we provided was provided without any losses to the taxpayer. Indeed, the emergency lending facilities resulted in $9 billion worth of interest and fees that were passed on to the Treasury. As I was explaining to Congressman Jones, the facilities were designed to provide real relief to American consumers and small businesses in the form of student loans, in the form of auto loans, small business loans, credit card loans, as well as allowing the operation of companies that relied on the commercial paper market, which had frozen up, to continue to find a source of funding to keep their operations going.